Hey, welcome to the Victor H Investing live stream. I'm Victor, and it's nice to have a live stream midweek. It's after the market closed on Wednesday, May 8th, and it's been an interesting week so far. We had big earnings in the previous weeks of the big companies. Now we have some more earnings coming in for mid-sized companies, and it's interesting to see how their stocks are reacting. It looks like we've got some people on. Hey, how you doing, Quags? Good to see you. And what I thought I'd do on this live stream is kind of review the stock market, see where prices have gone, and kind of share with you like what I'm observing. It's just one investor sharing his outlook. Am I bullish? Am I bearish? But I'll share that with you. Looks like Sergio's in. Sergio, very nice to see you. Thanks for tuning in. And then I wanted to get into some earnings that just came out today, and earnings from what I think are interesting companies like Uber, Airbnb, Arm, Robinhood, and I think most of them I haven't updated my analysis, so I thought we could look at their earnings, look at what was most interesting about their earnings, see how the stock price is reacting, and I'll update my analysis on the fly as well. And then last, there was a couple of requests. Some viewers wanted to see a couple companies that I'll review toward the end and kind of do a quick assessment and valuation. So it looks like No Man wants to see another stock. So let me catch up on comments. Thanks so much for joining, and thanks for the comments. Thanks for joining, Quags. I think it might be late where you're at. I appreciate you joining. No Man, I don't know that you've been on yet, or at least didn't ask a question. Thanks so much for joining. Take a look at BMBL. We definitely can, and we'll do that in a little bit, maybe in about 15, 20 minutes after I get through some stuff. So, all right, so let's jump into it. So first and foremost, the stock market it's never going to sit, still. It's either going to have headwinds or tailwinds. It's either set to go up or to go down. Now, guessing if it's going to go up or down is very difficult. But what I like to do is just add up things that either would push stocks up or push stocks down, and then set my expectation based on, well, are there more things that can push stocks down than there are that can push stocks up? Let's take a look at those things. So I'll kind of go through some things that I look at to set my sentiment, and that really lines up how much am I willing to invest currently. So to begin with, interest rates. Why are interest rates, really important? Is because interest rates have a couple of big effects on stocks. First, the discount rate that you see in my valuations, it's based on interest rates. As interest rates go up, I use a higher discount rate. As that discount rate goes up, the value of that company comes down. So if you have a company that is, a growth company, those tend to be hit the hardest. So values of stocks go down. That's why interest rates are important. And the second reason is, as interest rates have climbed, and investors can make 5% just by putting their money in a money market account, or even with a bank that has a good savings account, it competes with stocks. If you think about, hey, maybe you invested in one of these high flying stocks like Nvidia, Airbnb, and Meta, and you're like, okay, I've done really well in a year and a half. I'm going to take some of that money and put it into a safe place, which would be either a bond or a savings account, and just kind of wait this thing out. So that's why interest rates I'm going to put that in the category of, this would be an item that would push stock prices down, is a high interest rate. As we look at other things that I'm looking at is the stock market expensive or inexpensive? And I'll show you the 5-year. We're looking at the S&P 5-year just to kind of show a couple of items. So at the very end of 2022, the market was, I think, priced high. It had really gone up on a tear. If you go from the very bottom post COVID, it was up 100% in, we'll round up, in 2 years. That's a phenomenal return. So it ended up correcting and it went down 24%. So around this time, stock prices were expensive. I don't know that anybody would argue with me. And hindsight's 2020. It's easy to see the past, easy to see the data and so forth. Now, as we go into 2023, which is not too far in the past, the stock market did really well for the whole year. It did upwards of 25%. Okay. Now, that was a good market, but even within 2023, we had these pullbacks. We had one in the springtime, it went down about 5%. And then we had one in the late summer going into the early fall. The stock market went down 10%. Even though we had a great year, we had two pullbacks. One was more than 10%, one was more than 5%. Now let's look at this year. So we've got 2024. And we had the high on March 28th. Try to get March 28th. And from the high to the very bottom, we went down 5.5%. And now we have gone up about 4%. All right. So this really hasn't done much to correct stock prices. I believe that stock prices are a little expensive. You can't get through this type of run, in my mind, and think, oh, stocks are affordable. Stocks haven't gone up a whole lot. No, they've gone up a lot. So that's why I'm like looking at it going, okay, do I believe this is going to push stocks higher or set us up to have stocks go lower? And it's the latter. I think the stock market's expensive and we could see these corrections happen in 2024. All right. So those are two things that are pushing stock prices down in the next, call it 6 months for me. Last thing I'll put out there is, Warren Buffett. Warren Buffett is, arguably the best investor of all time. And if you looked at his annual meeting, he just had it this past weekend, and you look at how much cash he has, $160 billion of cash. Incredible. And part of the reason why he has so much cash is that he doesn't see great opportunities to invest right now. So if he doesn't have great opportunities to invest, he's just going to keep money in cash. So that's another factor that's weighing on my outlook that, hey, overall stocks are a great thing. You can always find stocks that are discounted, but I just think the stock market's expensive. And I'm seeing some signals that it would not be a big surprise if we had a pretty solid correction between now and, let's say, the fall. Pretty good correction would be like 10%. And when it corrects, it's not like, you get stock prices evenly spread out. They all go down 10%. No, certain sectors, industries, and stocks go down far faster and more severely. And some stocks, usually the big stocks, preserve their value much better. So we'll see how those things shape out. But I wanted to start with that because I think we've kind of been on a go-go. Stocks are great, kind of momentum for quite a while. And I'm beginning to put more money into, cash. I've sold a couple positions and I'm beginning to accumulate a little more cash because I think at some point we're going to have a correction, and I just like to have some cash. If Warren Buffett thinks holding cash is a good idea, it's telling me something. So wanted to begin with that. So I believe there's fear in the market, and there's fear from these big institutional investors that will sell their positions in their minds before everybody else does. As we look at earnings reports, I'm picking up some signals in those earnings reports, and I'll point those out that, again, align with how I'm feeling about it. So again, I could be wrong, but I wanted to share it with you. It's one investor's opinion. Would love to get your thoughts on it. All right, so we're gonna look at BMBBL. Quags has got another thing. Look at Camden, Mid American, Avalon. These are REITs. Yeah, we can look at them. So let me make a quick note. We're gonna look at Camden, Mid American, and Avalon. Okay. All right, perfect. Thanks, Quags. I'll get to that in a few minutes. All right, so let's take a look at one of my investments, one of my favorite companies, and that is Airbnb. So Airbnb, over the last year, it's done well, up 24%. It's if you measure from the low point to the top, it's done really well. It's if you go from here, $85, it's up quite a bit, and it really had a nice 2023. But they had their earnings, and the stock's down 8.55%. Okay. So you look at their earnings, and let's see what we got. So Airbnb is in the vacation rental industry, and they're kind of like an Uber, where Uber doesn't own the car. They don't drive the car. They don't clean the car. They don't maintain the car. They just have people connect with drivers and go for a ride on Uber. Airbnb does the same thing for a vacation rental, which is a private residence in a place that you're going to visit. And it works really well. I'm a big customer, and I like the company. So they grew at 18%, which was as expected. So it met expectations. They grew the company 18%. Very good. In the first quarter, they have 2.4 billion. That looks good. Net income, they're profitable. And this is a fairly young company. They've been publicly traded for like 3 or 4 years. They had adjusted EBITDA, and they have really good free cash flow. $1.9 billion of free cash flow in the first quarter, which is higher than what I was expecting. So this is good news from Airbnb. Their guidance is that the second quarter isn't going to be fantastic. It's just going to be okay. And the stock price is selling off. In the same guidance, they said that the second quarter isn't going to be overly exciting. It's just going to be okay. But the third quarter should be really exciting. But nonetheless, investors are selling off the stock. In my opinion, this proves that there's a higher propensity right now to sell off, that stocks are expensive, and investors, especially these, hedge funds and big money managers, they're managing these big mutual funds. They don't want to be the last one to leave a position on the downturn. They want to be one of the first ones out. And for Airbnb, which is a high quality company, to go down 8.46 to me is overdone, and a signal that, hey, the market's scared. So to go further, I'm going to do a quick update to my valuation. So we're looking at my valuation spreadsheet. If you've been to other live streams, you've seen it. You've seen my videos, you've seen it as well. So let's find Airbnb, and I'll update my analysis or my valuation on the fly here. All right, so we have Airbnb. Last time I updated was April 24th. So you see here for free cash flow in 2023, I was expecting they were going to do 3.8 billion. Well, they've already done half of that in the first quarter. So it's much better than expected from a cash flow perspective, which is one of the methods that I use to value companies, and it's the primary method that I use. So that's good news to me. So what I'm going to do is I'm going to say, you know what, they're probably going to have a faster growth rate there. So I'm going to go times 1.25, and I'm going to multiply last year's number and grow it by 25%. And I'm going to say that's what I expect the company is going to be closer to, as opposed to that number was too low before. All right. So will cash flows grow in the future at a good rate, 20%? It's easy to, I think so. They're going to grow more than 20%, because in this quarter they grew at 41%. So, okay, great. So they're going to grow at 20% for years 2 through 4, and then 4% in terminal value, meaning all cash flows after year 4. Discount of 8.5%. That's fair. They have very good balance sheet, but they're a young company, which is why it's higher than what I would use for, like, let's say, Alphabet or one of these really big premium companies. So I get a value of all those cash flows of 148 billion. And I don't have their balance sheet easily available, so I'm just going to leave these idle and just kind of go through and update the other data. So if we look at the market cap, it's 101 billion. And that's before the market drop. So if we expect it's going to drop 8%, it's going to be 8% lower than that. So I will go ahead and adjust that. So it's going to be a $93 billion company tomorrow. And they've got 644 million shares outstanding, 644.5. So it's going to round up. So an intrinsic value per share is 242. Stock price is at 157.90. So with this earnings, based on my model, Airbnb got more valuable, but the market's selling off. So that's good. I'm already, in the positive with Airbnb. I have an unrealized gain. So that's good. I hope it discounts even more, maybe another 10, 20%, and I'll buy even more Airbnb. Looking at earnings per share, let's go back to their earnings here. So free cash flow looks phenomenal. Now, there's no big surprise that when we look at the world's most valuable companies, and I'm showing you the world's most valuable companies here on the left, they all have this in common. They all produce a lot of free cash. Study Microsoft. It's incredible how much free cash flow they generate. Apple, Nvidia, Google, Alphabet, Amazon, Meta. These companies produce free cash flow. Now, when we look at Airbnb, this is a cash flow generating company. It's a young company. This could be the next Meta. And it could be, this big, massive $1 trillion company. You think about their addressable market, meaning how many homes around the world can they possibly rent on their platform? It's a big market. They're growing internationally really, really well. So it's an exciting company nonetheless. All right. So I'm not sure if I'm going to have earnings per share. I think it might have been on the very beginning. Oop, I went too far. So net income. I don't have it there, but I think I'll get it through one of these. Okay, so they grew 18%. Earnings per share, 41 cents for the first quarter. So I'm expecting they're going to be at $4.46 for the year. The travel season tends to be summer related. So I'm going to leave my earnings per share where it's at. I'm going to leave that at 36 and just leave this valuation as is with the new stock price. So overall, I think Airbnb is discounted combined by 40%. When I look at my investment in Airbnb, it's down here, and I have $77,000 invested. It's worth $110,000, and I'm gonna be a buyer of Airbnb. All right, so we just covered Airbnb on the fly. Let's take a look at, and again, back to my theme of, man, these stocks are selling out fast. Airbnb, to me, had a very good operating business. Their cash flow is better than expected, but they're selling off. So that's telling me the market is ready to sell off. It's nervous. It's scared. Next company we're going to look at is Robinhood. I love Robinhood. I don't use Robinhood because it just doesn't make sense to me. I think a lot of people love it. I love owning the stock. So their stock is actually up. That's interesting. Okay. And when we look at Robinhood, let's take a look at what happened. So for the first quarter, revenues increased 40%. Very good, Robinhood. Transaction-based revenues increased. Net interest revenues increased. I mean, these guys are firing on all 8 cylinders. And if you've seen my stock video on Robinhood, here's what I believe is the value of the company is they are not looking to get me as a customer. I'm more of like an old school spreadsheet kind of guy, analysis. I mean, you've seen my videos. They're going after the new school investor. They're going after the investor that grew up playing Counter-Strike and, Minecraft. And that investor has a particular way of thinking and operating, analyzing data, and so forth. That's who they're trying to get on their platform. I'm older. I'm 55. I'm not a Robinhood customer. I'm not. I'm a other brokerage customer. But I think that investor that's, 18 to 35-ish is probably happy with Robinhood. They like investing that way. They like thinking that way. And that investing pool of investors will continue to get bigger and will continue to accumulate wealth. Robinhood is almost, I would say, is dominant in that space. And it's going to freak out the other firms because the other firms like Fidelity and Schwab and all these other guys, their investors are quite old. They're dying off. They're not active. And they see that, hey, Robinhood's taking a lot of the new investors. They're going to continue to grow and take away market share from us in the new arriving investors in the market. So Robinhood looks good. They grew their revenues. And what other things would I point out? All right. So when we look at, this is going to look at the balance sheet. Robinhood carries a lot of cash. Very good balance sheet. So this is the cash they have access to, and they can control, spend, do whatever they want. $4.7 billion. Excellent. And they generate free cash. So that's just cash they can use to grow. They can use to market. They can use to, have commercials and all kinds of stuff. The revenue, phenomenal growth. Great job, Robinhood. 40% growth. Awesome. Looking at free cash flows. So this is 3 months ended March 31st. We have net income and we had negative cash from operations. Why is that? Let's see. So they had negative, they had 692 million from securities segregated under regulations. Okay. So they had to remove it off their balance sheet. And then they had receivables, I guess, go up. Receivables go up. And then their borrowed securities went down. So they paid those back. So a lot of things were negative impacts on cash flow. But the thing I'll point out is they weren't that they operated poorly. It looks like they were paying off a lot of accounts receivable. They were paying back borrowed securities. So this one here, although I like to see the number be positive every quarter, I think this is temporary and they'll probably recover for the year. Now, looking at my intrinsic value for Robinhood, and keep the comments coming. I'm going to take a little while to get to the next one because I wanted to keep my train of thought as I look at these companies, but keep them coming. I'm going to read every single one and I'll respond to every single one. So we're going to look at Robinhood. And last time I updated was February 13th. And it looks like I was going with my estimate of being 500 million of free cash flow. I'm going to keep that. And you see how I have a high discount rate on Robinhood. Reason for it is young company. A lot of things can happen to a young company. A lot of things could be surprises. So I'm going to keep that there. And really the valuation of this, what's the stock price now? $17.85. Yeah, it's fairly priced right now. So Robinhood's fairly priced. They had a good earnings. Their growth really impressed investors, but their cash flows are right now not showing me enough for me to be bullish on it. I'm gonna own, I'm gonna hold my shares in Robinhood. Let's see, where do I have that? I think I have it up here. So here's Robinhood, and I have $11,000 invested. That investment's worth $20,000. So I'm doing well with the investment, and I'm going to hold that investment because right now I think it's fairly priced. It's a great company. I like owning Robinhood, and I'm going to continue to own it. So that's Robinhood. It did not sell off, which is good to see. Their earnings were just too good for the market to sell it off. Here's ARM Holdings. ARM Holdings is in the semiconductor industry, and they're tied to the whole AI build out. Hey, we're going to need semiconductors, big time to build out the AI infrastructure. And they're selling off 8.55%. And they crushed their earnings. But their forecast wasn't exciting enough. And that's another signal to me that, okay, maybe the AI hype is losing some of its hype. Maybe investors are now beginning to feel like, a lot of these AI stocks are worth a lot of money. These guys are worth $109 billion. Their current revenue is $3 billion. You're paying 34, 35 times revenue for this company. And the semiconductor industry is cyclical. They have up and down years. So it's interesting. I'm not an ARM investor. This company is too young for me to invest in. I like seeing positive cash flows for a while, unless you're one of these, companies like Airbnb or Robinhood that, to me, their model just creates cash. But these guys have just been around publicly traded for, I think, less than a year. They've only got 2 years of financials out there. But I just wanted to point out that ARM is getting sold off. Another company that's getting sold off is Uber. And Uber it's interesting. This goes into the category where Airbnb's at. I thought their earnings fairly decent, but their stock sold off 5.72%. I bought more shares in Uber today because I thought, I'll buy it at a discount. Thank you very much. And when I look at Uber, it's been a good stock. I've got $34,000 invested. It's worth $59,000. And right now I have it it's just slightly discounted, and I have it hold. When we look at, the cash flows and everything, I updated this one already. I updated everything with cash flows, and it's fairly priced based on cash flows. The earnings per share look good, but it's only an 8% discount. So I'm going to hold on Uber, but it also is in the category of, hey, it had a really good quarter. It just didn't, when a company announces and says, hey, this is what we did, we actually did better than what we told you we were going to do. That's part of the earnings. And the other thing that the analysts want to hear is, how are you going to do in the future? And sometimes these companies pump the brakes and say, we're unsure. Hey, we see some headwinds. We see some struggles ahead. That's when a stock sells off. In the case of Uber, they didn't say that. They just didn't come out and say, oh, the future is going to be even better than we thought. They didn't beat and then raise. They just beat and said, okay, we should have an okay next quarter. So we'll see what happens. All right. So that's Uber. It looks like somebody has an Uber comment. Let me pop that one on here. So Tom Liu, thanks for joining. Uber is great, but it's investment loss. Yeah. So they have some investments that lost $725 million. And that's not good. But one thing that I always keep my eye on is the business. If the business is operating well, is it growing? Is it profitable? Is it generating free cash? And the core business to Uber is doing well. This investment, yes, lost money and it's bad. But I don't treat it as, okay, they're not going to lose $725 million over and over and over again. But their business at their growth rate is going to continue to generate value year after year. So that's where I put that in that category. Thanks for pointing that out. I appreciate it, Tom. So Uber sold off. It, again, is a signal to me that, hey, the market is going to be sensitive and it's going to sell off stocks. Sometimes for reasons that I don't understand, but it's just the sentiment that I'm picking up on. All right, so I've covered Uber, Airbnb, Robinhood, ARM, and those were the ones that I wanted to cover just coming out of the gate. Now let's talk about companies you wanted to talk about. And I think let me catch up on some messages and then we'll go from there. So it looks like I'm a little behind. So sorry, Quags. I think you had a comment earlier. And you said you don't use Robinhood, but you consider owning the stock. That's exactly where I'm at. As I don't use Robinhood, I've tried having a Robinhood account. To me, it's too simple. It's like it's very linear, not even linear. It's very simple, and I like to have a nice broad. I mean, you're looking at my screen. I like to see a lot of data, bring a lot into my thinking, and bring it into my process. So I'm right there with you. Sinanoptograpers. Oof, that's hard for me to pronounce. Okay, take a look at BEPC. I'll put that on the list. Thanks for joining. We'll get to that. Missed yesterday's sector rotation upload. Yeah, so I'll talk about sectors. Good idea. I'll talk about sectors. That is a good point. And I'll talk about that after we go through these stocks. Let me catch up on some of these comments. Take a look at AMP. Okay. Put that on the list. I'm not familiar with that company. PT, thanks for joining. Check EXPE. All right. So let's do this. So let's start with BMPL. We got more comments. 1 second. So I think we already went over Tom's comment. I agree with you, or I should say I acknowledge that loss on that statement. And then Expedia falls under $100. Again, I'm buying. Okay, Expedia's in travel. So, just a quick comment on that is travel's done really well. If you look at my United video, United is just crushing their revenue. It's just growing so fast. So anything related to travel, needless to say, during COVID, nobody could travel and they were saving up a bunch of money. Now everybody's traveling and they have money to travel. So cruise lines, airlines, Expedia, hotels, Airbnb. I'm really optimistic that category is going to continue to do well. All right. Do you own any BDCs? Tell me more. Quags, what is BDC? Can you comment on that? What does BDC stand for? Excuse me. I own Maine and Roth and HSA. I'm not sure what HSA is. All right. So we're going to get into BMPL. So BNPL. No, BNBL, excuse me. So it's Bumble. So Bumble provides online dating and social networking platforms in North America, Europe, internationally. Okay, got it. So it's a $1.79 billion company, so it's a small cap. And forward P at 15, that looks really good. The forward PE is nice. Buy rating with a 61% discounted price target. That's phenomenal. That's the highest I've seen, I'm going to guess, in the last 6 months. Okay, so what makes this company? 2 hours ago, Bumble beats first quarter revenue estimates, shares surge. It's up 11%. Okay, so it's a $1.79 billion company. Let's take a look at the revenue. So the revenue's been growing nicely year after year. Good. Their cash flow. So operating cash flow, $182 million. And their CapEx is, call it 15. So 15 million, 182. When you net the two, we're going to get down to $167 million of free cash flow. Back to my earlier statement, companies that produce free cash flow carry higher valuations. Bumble is going up. Investors like free cash flow, and investors love growth. So if you grow and if you're profitable and generate free cash flow and you have a good balance sheet, you're going places. So looking at the balance sheet, we are looking at cash of $355 million. What about debt? Debt of $615 million plus, call it six, so $621 million. So you net the two, you got about $250 million in net debt. So that's debt minus cash. So $250 million, that's not too bad. Their EBITDA is probably going to be about $500 million. So yeah, balance sheet looks good. So let's take a look at their earnings release really quick. So it's BMBL. Revenue increased 10%. Very good. App revenue increased 11%. Very good. Okay. App users paying for the service went up 18%. That looks good. And okay, so their users have gone up. Very good. Now let's see if they give us a income statement. Okay, assets we expect. Okay, their cash went down a little bit from 355 to 262. Where did their debt go? Their debt went about the same, 614 million. So yeah, their debt stayed about the same. Their cash position went down a little bit, about 90 million. All right, and so here's the statement of cash flows. Here's for the current year. And cash flow is pretty down, 2.4 million. And then their CapEx is 2.8 million. So conceptually, I think it's an interesting company. If you take, I think I got to 165 million and you multiply that times at least 20 because it's a growth company, you're going to get to about a $3 billion valuation. So I think it's interesting to track. It's not going to be a stock for me. My stocks that are small have not done well. My small cap stocks have lagged big companies. I don't know why. I don't know if it's going to change. I can just tell you, if I'm investing in small companies and they lag, I can't continue to invest in small companies. This is an interesting company. If you really like them and you don't have too many small companies and you want to invest in this, hopefully whoever asked this question already owned the stock and you see your stock value go up by 11%. So that's Bumble. Looks really good. Looks interesting. All right, so let's look at these REITs. Let's go with Camden. So Camden, is it Camden Property Trust? I think it was it Quags that asked this, or who asked the REIT question? Yeah. So Quags, is it Camden Property Trust? I think it is. So this is real estate company primarily engaged in ownership, management, redevelopment, acquisition, construction, multifamily apartments. So this is a very good category. So this is I know that certain commercial properties like office space, I mean, they're just in a bad spot. Everybody is going to work on Zoom. Office space is now not really that needed. But apartments are in high need. I'm in California, Southern California. We need more housing. We need more apartments. I think the whole U.S. needs more apartments. So this is an area that I think is really in big need. I've looked at some REITs that do multifamily, and they look good. So let's take a look at this one. So right now, the stock over the past year, no big surprise with higher interest rates. It really puts a lot of pressure on a real estate company. It's not doing great. It's an $11 billion company. They pay a 4% dividend. Analysts say that it's 3% discounted and there's a buy rating. Okay, looks good. Now, the way I value REITs is I look at the dividend, make sure that it has less than an 80% payout ratio on funds from operations, and also look at the earnings per share. So if we look at the dividends, it has 100% payout ratio. So I want to do my homework on that, because if it's the way REITs pay out dividend, it's a percentage of their funds from operations. So that dividend could be taken down. It could be taken down to 3%. It's just a factor of their funds from operations. So take a look at that. And then their earnings per share. So in 2024, it's supposed to be $1.72, which is down from last year and down from the year before. Okay, that's a little concerning. It's not going to grow a whole lot, 4% in 25, and it's supposed to really go up in 26. So I think Camden, I would do some homework on, see a couple of things that concern me on that one, and just make sure that you're seeing it eyes wide open. The other one was Mid-American. Yeah, here we go, apartment communities. So you see how these charts were similar from Camden to this one? It's those interest rates. As interest rates rise, and I could probably, you know how I showed you that interest rate chart? Let me bring it back up because I think it's interesting to point out. You will see that this interest rate chart, all right, so you notice anything similar? This is the interest rate chart. Look at their chart. It's almost identical. See how interest rates affect equities, especially real estate companies. Okay, so these guys affected by interest rates, okay, no biggie. Because if you buy at the right time, when interest rates are going to begin to drop, I think interest rates are going to begin to drop late 2024. So if you buy it at the right time, you'll pick up a nice REIT, be paid a really nice dividend, and then as interest rates go down, the value of this stock's going to go up. So buying at the right time is a pretty good opportunity. It's a $15 billion company. Forward P is 31, pays a nice 4.42% dividend. Analysts say it's 10% discounted. Dividends have a payout ratio of 123%. So I would study funds from operations and do your calculation on funds from operations to understand what's going to be the dividend going forward. Right now, this is a big aggregator website, so it could be wrong. So I would do my homework and see what you think is going to be the dividend going forward, and is it healthy based on funds from operations. The forecast, if we look at earnings per share, it is earnings were going down. I wonder why. I don't think apartments are being discounted or anything. They're still in huge demand. It looks like during COVID, it went up. Okay, good. And then it went down. That's strange. That's a surprise because at least in California, apartments are in high demand. It's like, man, property owners are doing well. So this one here, I double check the dividend, make sure that you're seeing, that it's going to have a decent funds from operations. I'm going to show you an example of my REITs. Probably my favorite one is CTRE. So these guys, they rent out basically an apartment to an elderly person that needs healthcare. They need a nurse to administer their medicines. They need some kind of healthcare, and they live there. I've done well with this REIT. They have less than an 80% payout ratio. They're fairly priced right now, but I'm up on this stock nicely. I bought it at the right time. They pay a nice 4.51% dividend. I invested 32,800 into the stock and it's worth 45,000. So I'm up on the stock and they pay a nice dividend. So buying a REIT at the right time is a great idea because it'll give you really good income and you can have good appreciation. Right now, I'm not buying REITs because of those high interest rates. I'm just holding on CTRE. The exception being MPW, which is high risk stock that has earnings tomorrow, by the way. And this stock is either going to go up 10, 20%, or it's going to go down 10, 20% because it's high risk. So that's a quick one on Mid-American. And now let's take a look at Avalon. I think I looked at Avalon, but it's been a long time. I think it is an apartment REIT. So I think it's Avalon. Is it Avalon Bay or Avalon Holdings? Nope, it's not that one. Okay, so Avalon Bay, I think this one might be it. Apartment communities. Okay, cool. All right, so this one here, again, if we look at the 1 year chart, this one's different than the interest rates. It owns apartment communities, $27 billion company. This one's more than the other two we saw. 3.5% dividend. It's a buy rating. It's fairly priced. All right, so when we look at the dividend, it's a 100% payout ratio. I double check that, make sure that you see that in their financials. Sometimes these aggregators make mistakes. And then we have earnings are growing, which is good. It went down from last year, but it is going to grow in the future. So that's good. I think that a general kind of business observation is these apartment REITs, they're going to be in demand. Okay. So it's not like you're buying into an industry that's going to have a tough time. No, I think these guys have a lot of demand for their product. So I would do my homework. And if you have a desire for income, REITs are a good place to go. I limit my exposure to REITs because I own real estate that I rent out to people that rent it directly from myself and my wife. So I don't want to get too many REITs because I already own real estate, and that's a pretty big part of my net worth. So that's why I kind of pump the brakes on too many REITs. But I like REITs overall. All right, so going down the list, we got BEPC. And that is Brookfield Renewable Corporation owns and operates portfolio renewable power and sustainable solution assets primarily in the United States. So this is a power company. So renewable power, okay. 5.4 billion revenue, 5.5, okay. Forward P21, really nice dividend of 4.74. Analysts say it's discounted by 13%. So one of the things that usually is a showstopper for me is their cash flow. Let's take a look. So this one's pretty good. Usually what I see is operating cash flow is about the same amount as CapEx, but not this one. They have about 700 million in free cash flow in 2023. They had positive cash flow of, call it 450 million in 22. And then these years were different, but this one was a good year. So at 700, and they had this one looks good. So this one would totally look good in a valuation. So the cash flow looks really good. Now let's see the forecast. So why am I not getting earnings per share? So we have a loss of 49 cents, a loss of 58 cents, a loss of 14 cents. Okay. So this one has negative earnings per share. No big deal. Okay. A lot of companies, Amazon's a good example. I think they were losing money for like 20 years, but they had a $500 billion valuation. It's like, well, how did that happen? It's because everybody knew they kept growing and they were creating a lot of value and just growing their top line. If we look at this top line, this company looks really good. And it happens to be in a category where I've been looking for a good power company. They're kind of hard to find because most of them, I can't get them to have a decent valuation. So let's take this one through the model really quick. All right, so we're going to look at CVX, which is an oil company, but it is an energy company. So we're looking at BEPC. That's Brookfield Renewable. All right, so this is a smaller company, so I'm going to go with about a 10% discount rate. I just said that their free cash flow is about 700 million, right? And that was their free cash flow last year. I'm going to say that they're going to grow. The demand on power is extreme right now. Don't need to tell everybody on a computer right now with internet and so forth. So the demand with power is just going to continue to go up. These companies, basically have a business if they operate it well forever. But see, just based on cash flow and those growth rates at a 10% discount rate, it values the company at $11 billion, and they're a $5.39 billion company. Okay, looks good. Let's look at the balance sheet, see how much cash and debt they have. So the cash is 916, and then debt is long-term debt 15 billion 557. Do they have any debt in their short term? So current debt. Come on now. So current debt is 2.33. So I have to add the 2. So this is going to be so that is quite a bit of debt. So we're going to have to see what their debt to EBITDA ratio is. And you see now where the problem is, right? You have their cash flows are going to be worth 11.3 billion, but the debt on the balance sheet takes away all that value. Because if you bought this company, you would basically, let's say you bought this company like, hey, I just want to own the power company. Okay, that's fine. I'm going to buy all the shares. Okay, that's fine. And then I'm going to, pay all the debt off. Well, you wouldn't get your debt back. You wouldn't get all that money you spent on the debt. You'd fall short of that. So that's what I'm trying to show there. So this is a showstopper for me. Okay. Hopefully that makes sense. That's how I value companies is how much cash flow you're going to generate. Like here's Chevron. They're just a money, cash flow generating machine. This is their value of the cash flows, their cash. Their debt is 21 billion and they generate like $400 billion in revenue, way bigger than these guys. It's the debt level that's really a concern here. So showstopper for me, and I cannot invest in that company. Good question. I like going into power companies. I continue to look for one, but it's been something that I haven't been able to find. They usually, and FYI, if I never find something that's acceptable, that's life. I'd rather find something that's acceptable and meets my investing criteria, and I make money or lose money following my criteria than going out of my lane. Because when I lose money, when I get out of my lane, I just feel terrible. Like, what the hell am I doing? I either follow my process or I don't. If I follow my process, I continue to learn and get better. If I get out of my process, I learn nothing. It's just, I learned bad habits. So, all right, enough of that. So this is a pharmaceutical company. I like pharmaceutical companies. This is a small pharmaceutical companies. I already had my, speech around small companies. Revenue, 644 million. Okay, looks good. 3 times revenue. Forward P is really low. Very good. Cash flow. Positive cash flow by about 145 million. Last year, free cash flow. Year before, free cash flow. Very good. Income has been growing. Very, very good. So I've been finding a lot of pharmaceutical companies that look like this. Profitable free cash flow. This fits right in there. So it's been down recently. Looks like it's had some pretty good highs. Now it's been really discounted. I think healthcare in general has been discounted, and it's going to come back. I think it's going to come back. So this is an interesting stock. It's a very small company. One of the reasons I wouldn't invest is if you look at my positions in healthcare, I already have a couple of, three. I have Catalyst Pharma, Harmony, and United Therapeutics. I like these companies. I have not big investments in the bottom two. I've got like 5,500 in each, and then close to 14,000 on Catalyst. Catalyst was doing really well. I was up on the stock like 40, 50%, and it's been on a downturn. I think healthcare in principle or in general is really discounted. So I think that this company that we're looking at over here, that's a pretty interesting company. I would do more homework on it and keep an eye on it. I have plenty within healthcare, so I'm not going to keep it around in my watch list. And then the last one before we hit sectors is going to be EXPE. And that's Expedia. All right. Okay, so Expedia over the last year, up 21%. You can see COVID. Look at this COVID dive, and then it came back. Very good. Then it dove again. That's surprising. Okay. But the 1 year, that's pretty decent. Okay, good. Forward P is nice and low. I know these guys, Expedia, you guys are probably all customers. I've used them before. You can book your travel and hotel and stuff on their website. The one thing that I'll say toward the end. So revenue growing nicely. Grew 10% in 23. That's good. Did they have their earnings? So it looks like they don't have their earnings yet. So, all right. So financials, when we look at cash flow, they cash flow really well, upwards of 1.65 billion, which is very good cash flow. And their market cap, wow, market cap's really low compared to that cash flow. So that looks good. And they are growing. That looks good. If we look at their forecast of earnings per share, very good. So did these guys report already? So yeah, here it is. So earnings release. So bookings grew by 3%, and then revenue grew by 4%. The revenue overall grew by 8%, which is good. They had a net loss. Huh, interesting. Wonder why they lost money. Okay. So I'm surprised they lost money. They don't have like a big cost structure. I guess a lot of it is in marketing. They have to really compete for eyeballs to earn that booking. And here's where I will call out why I don't invest in Expedia and why I invest in Airbnb. So Expedia doesn't have a competitive advantage. They didn't create something that's unique where I can only go to Expedia for this. You can go to Expedia. You can go to Google Travel, which is really cool. That's typically what I do. You can go to like 20, if not 30 websites to do what Expedia does. That's tough competition. That's why they have to spend so much money on direct marketing. Okay. Airbnb, I believe, is the leader in private residence rentals. They're the leader. Customers love it. They like that website more than anything else. And that's why I think Airbnb actually has a moat, a competitive advantage that keeps their competitors away. Airbnb's competitors are like Booking, and Booking is not like Airbnb. It's a little different. Booking, you could say, is a lot like Expedia. And after that, Airbnb has some legacy, competitors like VRBO, Flipkey, and they're just destroying those guys. Those guys are on their way to be irrelevant. So that's one of the reasons I don't like Expedia, and it's showing up in their income statement. That's why they lost money. I was like, trying to reason why are they losing money? If you have more people traveling, should you be making money? Cash looks good. They have cash on the balance sheet. And then cash flows look good. They actually produce really good free cash flow. I think if you believe in Expedia, I think it's a pretty good bet. I would just put the expectation out there that they're in a highly competitive segment industry. And, imagine AI. Why would we need, websites like this in the future if you can have AI? AI can look at all travel, like, hey, I want to fly from San Francisco to Paris. What's the best flight to take if I want to spend the least amount of money and have a direct flight? That would be an AI question, and it would get it to you that quickly. And that's going to be a big threat to Expedia. Okay. They're not going to have anything to defend themselves against something like that. So that's my opinion. I could be wrong, but I hope you found some value in what I shared. All right. We just covered, 10 companies. So that was fun. Let's get back to some of these comments. See if I can pick up where I left off. All right. So Bad Omen, good to see you back. Thanks for joining. Take a look at CPRX. All right. We can take a quick look at that. And then appreciate so thanks for joining. Really appreciate you asking about that company. Cool. Snowflake. So comment on it. Appreciate it. BMBL soon being a downtrend. Yeah, it looked interesting to me. It's just a small company, and I could show you small company after small company, and they have great valuations, but their stock prices don't move up like the big caps. And then when they have any kind of bad news, they just fall down really fast. And then Snowflake, CPTs, REIT, awesome. All right. So Quags, are you in Orange County, California? That's where I'm at. So all right. So looks like we covered AMP. Yeah, it did look interesting. Shadow Guy, good to see you, man. Thanks for staying up late. Yeah, California, it's challenging in California. Real estate prices are really high. Hazard insurance is expensive, but nobody wants to leave. A lot of people want to live here. So I'm glad I own, our main family home here in California, and we own 3 properties in California, investment properties that have done really well. So it is a tricky market. You got to buy at the right time so that you can make money and not lose a bunch of money. All right. So Snowflake, AVB, we'll take a look at that real quick. And then Quags, thanks for joining, Quags. Really appreciate all the comments today. Thanks for bringing it. Looks like we have a comment. $10 billion investment from Microsoft into BEPC for AI. So this is the energy company? Well, that might be a game changer. Well, I got to look at that one further, and I am going to look into that further. Again, I've been trying to look for a good power company, but I've yet to find one that is the perfect one, and I'm going to keep looking. Thanks for that note. I'm going to look into it further. Question here. Do you ever buy preferred shares? No. I either buy bonds or I buy stocks. I'm primarily a stock investor. I buy real estate. I own the property. I, run it out and so forth. Preferred shares. I can't speak to it much because every time I look at them, I'm like, well, I'd rather own a bond. It's like, why would I want to own preferred shares? They don't yield like a bond, and I just disqualify them very quickly. Do you ever buy preferred stock? I think I just went into that. Then Sergio. Yeah. Power companies. It's no big secret that, like AI is a huge, like, power consumer. And then if you think about other power consumption around the world, it's just going up. It's pretty incredible. So it's most definitely an industry that has high demand, and companies going to have to, the good companies that operate well profitably are going to do really well. All right, so let's take a look at CPRX. Oh man, how did I not recognize this? So CPRX is a stock that I own, and I really like the company. Revenue, look at the revenue. This is a pharmaceutical company. They have one principal drug that's done really well, and they've been acquiring other businesses to fill in their product portfolio. Look at their cash flow, nice cash flow. CapEx is almost nothing. So all this is free cash flow that you're seeing here. Okay. So at $143 billion of cash flow, they're $173 billion company. They're growing very quickly. So if you look at their cash flow, multiply times 20, because they are a growing company, you're looking at a $2.8 billion valuation, but their valuation is $170 billion. If you look at their forecast, they're going to be growing their earnings per share nicely. So this has been a stock that I've been in for a year or so, and it was doing great. And then healthcare has been really beaten up, and it's not going to be beat up forever. And it's going to come back, and I think it's going to really have a good return. I've invested close to 14,000 with Catalyst, and it's worth 15,300. So I got a 10% gain, but at one point I was up like 40 or 50%. I think the stock it's a good company. It's a good stock. That goes back to my point that I've been making with these small caps. What is the deal? I just showed you really good fundamentals. Growth, free cash flow, balance sheet looks awesome. Why are these stocks priced so low? Why don't they keep rising like, Alphabet or Microsoft? They're growing faster and so forth. I think investors are just like, hey, if it's not a name brand, if it's not a name that I've heard for a long time, I'm not going to invest in it. That's the mentality of the market. So it just makes an investor, value investor, got to do my homework, got to really, buy for the long term, because if they continue to grow and they go from 400 million to 600 million and become a $2 billion company, they're just going to be too big to ignore. Or a bigger pharmaceutical company like a Eli Lilly, a Pfizer, AbbVie is going to acquire these guys. They're going to be like, hey, I'll acquire this business. I get all that free cash. I get that growth. Thank you very much. And when they acquire a business like this and I own shares, it's an immediate 20 to 40% premium that I get on the stock, and that'd be a good day. All right. So that was CPRX. All right. So let's do AVB. And I think we just did this one. ABB, Avalon Bay Communities. I gave you my opinion on this guy. Okay. All right. Bad Omen. The expected EPS. And I'm sorry, Bad Omen, I can't follow your stream of thought. What stock are you talking about? Were you talking about Catalyst potentially? Then thank you for this alpha. Seriously. Okay, cool. Hey, thanks for tuning in, man. This live stream was probably the best attended live stream. We covered the most companies we've covered on a live stream, which was really fun. think we covered a lot of ground. And I think we're going to go over sectors, and I'll cover that in like 5 minutes. But what I wanted to leave you with is, I encourage you to have a process. You have your process that you feel like, when I find a company that looks like this, then I'm a buyer. My process is to really believe in the company. Like, hey, I told you how I believe in Airbnb. Have that type of like frame of reference. Like, hey, I'm a believer in Airbnb, or I'm a believer in apartment, REITs. And I'm a believer in this company. It's a very well operated company, or it's a comeback story. I'm willing to, like Intel is a comeback story right now. I'm willing to buy a comeback story if I believe in it. And I believe in the management. And then the balance sheet has to be in good health. You can find a really nice company with a horrible balance sheet, and it's just problems. I do not want to invest in that company. Then last is discount. I invest to make money, so I want a discount on the stock. I value companies based on free cash flow and earnings per share for the most part. Financial companies is different. I value on earnings per share and their book value, and on REITs I value based on their dividends and their earnings per share. So I can quickly go through a process and know this company looks really interesting, or you know what, it's deal breaker. I shouldn't spend any more time, because it takes a lot of time to just analyze the companies I own and keep up with them. But when I do find one, that looks interesting, I could dive into it because I have my process. I know what I'm going to like, and I just keep repeating it, and I keep getting better and keep improving, learning from my mistakes. If I have a losing stock, I'm like, what went wrong? Did the company surprise me, or did I misanalyze something? Okay. All right. So let's talk about sectors. All right. So companies are part of industries. Industries are part of sectors. So here's where I want to go with sectors. In 1 second, I'm just going to take a drink of water here. So I opened up with my sentiment is that the market's expensive, and it seems that investors like Warren Buffett are accumulating a lot of cash. And that's signaling that, hey, maybe we're going to have a pretty good correction, or maybe a couple of them here in 24. So I'd like to accumulate cash. And here I'm sorting. These are sectors from utilities, consumer staples, communication services, and I'm using the last month return. Okay. And you can see that utilities did really well. Utilities do really well when the economy is going to go into recession. Consumer staples did really well in the last month. Smart money is moving to utilities, consumer staples. Again, another sector that says we're going into recession. Communication services could be, good for recessions or not. Healthcare, it's up a little bit. I think it's going to do well, because look at the over time. If you look at the 10-year, I don't have it on here, but it's done really well. And then consumer discretionary is down here. Technology, industrials, and materials have done poorly in the last 30 days. Energy's done bad, and then real estate's really bad because we just went over high interest rates hurt real estate companies. And what I would want to say is this is one more signal that, the big money investors believe we're heading into some type of recession or some type of market correction, and they want to move to safe sectors that are consumer staples don't move a lot. This is like, Walmart, Procter and Gamble, Costco. These we consume every month, whether it's good economy, bad economy. People just are very accustomed to eating these things. And of course, utilities, you can't do without your power, your electricity, your water, those kinds of things. So that's one more tell that the market's saying we're probably going to have a good correction. And I don't know when, but I'd like to have a good cash balance. So if it does happen, like in 2022, I was glad that I had some cash to put into stocks that I really wanted because they're really discounted. And toward the end of the summer, ditto. I poured, investments into stocks, and then in the October 2023 timeframe, it just took off and it kept going. So I want to be in a place where I can, participate in a discounted market when it comes. All right. So that was a fun live stream, guys. Thanks so much for tuning in. Again, that was the best attended live stream we've had. And we had record number of comments. Really appreciate everybody, showing up, ready to talk stocks, ready to ask really good questions. I think we got one more from Quags, and then I'm going to call it, and we'll wrap it up. So we're going to look at BDC like Maine, Business Development Company. So BDC. I don't know if I got that one right. So would you look at a BDC like Maine? Oh, maybe I'm supposed to look at Maine. Sorry. Main Street Capital. So these companies have caught my this is like private equity, private companies that put the capital up and then an investment project happens. And I've noticed these. Wow, look at the stock chart. That's a beauty. So over time, not overly exciting, but this 1 year chart, that's a work of art for the last 6 months. Now, the thing about this type of investing is you got a small cap company. It does about 500 million. How stable is their revenue? So we're going, see how this revenue went 233, 243, 222, 289. It's been a nice growth trajectory. That's very good. That looks really good. That growth. Balance sheet doesn't really apply to them because they are actually carrying debt and capital. They have good operating cash flow with little or no CapEx. So this year's positive, but we had a lot of negatives. Okay, that's concerning. What's going on there? I'd want to understand that. Like, how did we go for so many years of negative cash flow? Forecast. So analysts expect this company is priced at a premium of 10%, and they just have a hold rating on average. Now, I don't take analyst reports, like the gospel. It's like, it's good. It's interesting to look at. I do my own analysis. So they have earnings per share in 24 of $4.17. And then it's going to go down a little bit. Okay. Yeah, this is not an area that I invest in a whole lot. I think the concerns that I've had is that I don't quite, these guys can make a couple bad moves and be bankrupt because they're small, and they can make a couple good moves and then be like worth 3 times their value because they're small. I already have in financial services, which is, I believe, where they're a financials sector company. They do asset management. Well, I'm already invested in, like I said, Robinhood, Citigroup. I have a smaller bank in US Bank. I own a pretty good number of financial companies. So I'm good with that sector. I don't need anything else there. And I feel like these companies like StoneCo I know what StoneCo does. They're in Brazil. They do credit card processing. They do digital payments. I get that. It's been a good investment for me. Coinbase, cryptocurrencies. That's been a super winner. PayPal, I know what they do there. So I got plenty in financials. I don't need any more. And that's why I would be like not an investment that I'm crazy about. But if you really know that industry and you have an information advantage, take it. Make some money. Buy it when it's low. Hold it. Sell it when it's high. All right. So, and they pay a high dividend. Yeah, pay a high dividend. Very good. It's dividend safe. Yeah, dividend safe. Yeah, that's one that if you have some inside information, and that's the wrong term to use. If you have good information on that industry, use it. Use it to your advantage. All right, Quags, thanks for joining. Appreciate it. And then a person, it looks like you missed part of the session, so the recording will be made available if you want to watch it. Thanks for tuning in. And then main is the ticket. Yep. Looked at it. And then I'm not going to do this daily. It's because as you can imagine, it takes a lot of time. I'll try to give you guys a little bit of warning, kind of like let you know in the morning when I'm going to do it, in the evening being in California evening, and we'll go from there. Any explanation why VST going straight up? So Vistra Corporation, 15%. Wow, man. What do these guys do? Retail electricity and power generation. Wow, impressive. So this stock's obviously working. So why? So market cap 31 billion. Dividend is nothing because the stock price is up so high. Let's look at cash flow. So remember how I was bad mouthing utilities? Look at the cash flow on this. Free cash flow of 4 billion. But previous years were kind of rough. 2020 was good. So that looks good. Balance sheet, I'd have to look at that. What's the debt? Current debt, 2.2. Long-term debt, 12.6. The revenue is, yeah, that's not too much debt because it's like 1 times revenue. These guys are a strong buy, but they're overpriced by 24%. So the analysts haven't kept up with the stock price. Stock price has moved up really fast. And their earnings per share is growing nicely. So this is that power company that I was looking for 2 years ago, and I never found it. So they're in the right space. And they're probably generating power. And they're probably generating power for like data centers and key places where the power growth is high. And it's probably in markets that are deregulated, so they actually can make more money than the average utility. That's why I think this stock's really moving. I was looking for this stock 2 years ago, and I didn't find it. Whoever found it, if there's anybody that invested a couple years ago, congratulations. You did really well. Good one. Thanks for pointing that out. All right, so we were at, hey, thanks for tuning in, Quags. Sergio, thanks for tuning in. Appreciate you joining. A person, thanks for joining. And looks like that's it. Everybody, have a great night. Thanks again for tuning in. Take care.